Welcome everybody to Billionaire Acquisition Mastermind, number one M&A podcast in the world. And today I'm bringing on my financial director, Paul GASTELLO. He's a manager in finance and strategy at Cash App at Square. So his bio states, I'm a strategic finance manager at Poshmark and former investor at Wellington Management. As a public markets investor, I drove annual returns of 57%, conducted discussions with public company CEOs and CFOs, and evaluated multi-billion-dollar M&A transactions as well as IPOs. I developed a deep understanding of how investors assess IPOs as well as what drives a public company stock performance. Paul, thanks for your time to come in and clear some doubts, especially for the new guys.
Yeah, no problem at all. I'm happy to be here and excited to have this discussion with you.
Great. So let's touch a little on small business evaluations. Now, brokers, the majority of people are talking about EBITDA, right? We had the EBITDA discussion. We touch a little on seller discretionary earnings and net income. So could you explain what is EBITDA used for and why is it used?
Sure. So EBITDA is it's a form of a profit metric. And it's so you net income, but that's after your taxes, after your interest, after depreciation and all that. EBITDA will stand for earnings before interest, taxes, depreciation, and amortization, right? So it's before you take into account the debt structure, right? Which you should be accounting for you should be adjusting for when you're evaluating a business to get to the enterprise value. And it takes out depreciation. And the reason it takes out depreciation is because it is meant to proxy for cash flow. Okay, so depreciation is really, it's an accrual thing. Like it's something that you have to have on the P&L and GAAP accounting, but people will tell you in making the argument for EBITDA that you don't really want to base the multiple or the business transaction on depreciation because depreciation is quote unquote not real. Right. Now, there's a pushback that I have against that we can go into, but I want to pause there and just answer the question in the simplest terms.
Correct. Yeah. So we're not looking at EBITDA. We're more so looking at a net income. Another thing to take into account is that earnings, taxes, depreciation, amortization are expenses, right? So we're not really using that to service the debt. We're using the net income.
Right.
So in the financial calculator you drafted up, I saw that there was unlevered free cash flow at the bottom. And essentially, I noticed the biggest difference I saw between net income and free cash flow was the deduction of capital expenditure. Can you go a little into that?
Yes. So the thing is, and this is one of the reasons that I have a pushback against EBITDA is that depreciation is maybe not going to show up on your P&L in a given month or a given quarter. But if you have a capital intensive business, that will come back to bite you, right? So I'm going to give an example to make it more tangible.
Sure.
I used to own a laundromat, right? A laundromat, you would say, is a very capital intensive business. Why? Because your whole business depends on those machines working, right? That's what it means to be capital intensive. You have hard, tangible assets that cost a lot. And what happens is every now and then you are going to have to repair those machines, and every now and then you're going to have to replace the machines. And that's real money, right? So that's why I'm kind of not for backing out depreciation, is because if you back out depreciation, then you're making an apples to oranges comparison between, say, a laundromat, which is capital intensive, and say an agency, which is not capital intensive at all. Now, you can kind of square that by saying, okay, well, if I'm buying a laundromat, the EBITDA multiple should be lower, accounting for the fact that it's going to be capital intensive and that depreciation will bite me in the ass versus the agency model. So that's the kind of pushback there. And that's why when you're doing an unlevered free cash flow analysis, or really any cash flow analysis at all when you're doing your DCF, you want to account for the fact that capital expenditures are a real thing, and that you don't get to eat those cash flows as a business owner. Those cash flows go to servicing and maintaining your place of business.
Right. Can you just expand a little what comprises capital expenditures?
Capital expenditures are really going to be any capital, any money that you put to work into your hard assets, right? So that's why I brought up the laundromat as a very good example, is because machines, washers, dryers, hard assets. It might also be like you buy an automobile to service your place of business, or if you have a restaurant, that's the cooking hardware that you have back in the kitchen. It's stuff like that. It's the real tangible assets that you buy on a periodic basis to maintain the business. That's what's called capital expenditure.
Right, and like you said, those are real expenses and they're paid with real money. So you got to take that into account. Now, in regards to investors, what do they go for? Internal rate of return, return on invested capital, or return on investment? Are they all interchangeable?
I wouldn't. So in like the strict finance terminology, parlance, the strict definitions, they're not necessarily interchangeable.
Okay.
But from like a more abstract conceptual level, they're all ways of gauging the kinds of returns that you're getting in an investment, right? So if you're doing return on invested capital, you're saying, oh, okay, I'm getting a 20% return on invested capital. If I compare that to a, say, 10% cost of capital, or if you got, say, bank financing at 5% interest, and that's your cost of capital, and you say, well, I invest in this business, I get 20% back on that investment. If I can borrow the funds and those funds only cost me 5% a year, then 20% minus 5%, I'm getting a 15% economic spread. And that's great, right? That's a good way of evaluating the returns of your business. And IRR and all these other methods, your rate of return, all that kind of stuff, they're just different ways, different lenses of evaluating the same thing, which is this a good investment or not?
Correct. Now, in regards to small business analysis, how can you tell if someone cooked the books?
So this is there's no easy answer to this, because you really kind of have to become Sherlock Holmes with this kind of stuff.
Right.
And there's a lot of ways of getting at it. But during the
some
due
more
diligence
surface level things you could, figure out.
Yeah, I mean the topmost protection that you can have is like having access to their bank statements and credit card statements. And we talked about this a little bit, where a business owner can conceivably cook the books, but between their credit card statements and their bank statements, you can piece together what the heck actually is going in to this business and coming out of this business. There are edge cases to that where that's not necessarily true. For example, intensely cash businesses, business owner might be taking some off the top before going to the bank and stuff like that. But that's one of the ways that you can protect yourself, is saying, okay, here are the books, here are the statements that you gave me on your business. Maybe I'm having trouble because it is a cash business, or maybe I'm having trouble because this thing doesn't square up. If I would love to see then the bank statements and the credit card statements as part of the diligence process. Or another thing that you can do, which is potentially a clue, is because if you're buying a business, put yourself in the shoes of the seller, right? The seller might have known for a year and a half, maybe 2 years, that they were going to want to sell the business in the near future. And as a result, start making things look better than they are. And so one of the potential yellow flags is when you're buying a business is all of a sudden in the past 9 months, you see upwards inflection. You see things are really going freaking great. So that's a potential yellow flag. And one of the things you can do there is you can say, like, okay, do I have any data points, other data points of people who own similar businesses, and what's going on in that business on the top line costs. And if what's going on with the target business deviates meaningfully from those peers, then you got to ask questions like, how is this? How is this that your revenues have performed 20% better than your peers have over the past 9 months, or stuff like that, right? And then lastly is the kind of business specific things that you can do. And I'm not going to go into this too much, because if I talk about one, that's not necessarily serving people who are interested in different businesses. But I gave you the example of how if you're buying a laundromat, you can actually back into the revenues of that laundromat by using the water bill, for example. Right. And so there's different ways of validating, but point being is this is a process that takes time. It takes care, and you want to be Sherlock Holmes during that whole process and be careful, because otherwise you might be stuck holding the bag on a business you don't actually want.
Right. Now, very quickly, and your checklist of things to look when acquiring for a business, what do you look for essentially, you know?
So this is a little bit case specific, I think. So it's hard to answer it from that standpoint, but I'll answer in terms of like what I was looking for when I was buying that laundromat, right? Here's why I like that business. It could be run semi-passively, right? I don't have to spend a ton of hours at that laundromat. It's very cash flow generative. I don't like to speculate on the growth of a business, or I don't want to pay a high multiple because it's dependent on it growing 2x in order to actually be able to pay the bills, right? Third, I look at a good return. So I should be able to buy well, right? If I can generate, again, going back to the idea of economic spread, if I can say borrow funds at 5% interest rate and use those funds to invest in a business that's generating 30% after tax, economic spread of 25, that's amazing, right? So that's and then personally for me, I also like to look for, or what I was looking for in that laundromat was recession resistant, right? And what I mean by that is like, when things hit the fan, which they inevitably do, is this business going to be okay still? What we saw with this pandemic was companies that were not recession resistant, already on very thin margins, going under or saddling their owners with tens of thousands of dollars in debt. Right. And that's very bad. Right. So those were the four things that I was looking at, or for in buying that laundromat. I'll also throw in here, if you're buying a business, it's good to look for a situation where you're buying from a liquidity seller. What do I mean by liquidity seller? When you're in the market buying any kind of asset, small business included, there are two kinds of buyers and sellers, right? There's let's just keep it to sellers. There's a seller who's looking for value, the most value that they can get out of the transaction. And then there's sellers who are looking for liquidity. In other words, they just want to get their capital, their money outside of that business, which is not liquid. They want to get their money outside of that business because they need it, right? And when you're a liquidity seller, value is not your concern, which means that you as the buyer can actually get a great deal if you're buying from a liquidity seller. So to give you an example, I sold the laundromat. I was a liquidity seller. Why? Because I had a situation go on back home with my folks in New York. I wanted to pull my money out of that laundromat and get the hell out of there as soon as I could. So I wasn't looking to get the most possible value out of the sale as I possibly could. I really just wanted my money out. And so my buyer got that laundromat for $150, whereas if I was patient and I really waited it out, I might have been able to get $280 out of that laundromat, right? So this guy was getting shit at a almost 50% discount. So you as a buyer want to look for those situations where you're looking for a liquidity seller, not for a value seller.
Right. Essentially, like I say, you know, there's two reasons why someone sells: time or money. Those are more the money guys. They're more motivated, right?
Yeah. Well, in this case, I put it on the other side. In this case, I was looking for time, not looking so much for money. But you want to look for those, yeah, you want to look for those liquidity sellers because you make out well as the buyer in those cases.
Right. Now this is big. A lot of people want to take into account future pro forma of the business when selling, because it's going to grow to us. We think this is a fair price. But honestly speaking, they're not the ones growing it. We are. So should they be compensated for it?
I I think it really depends. So if, for example, what by pro forma they mean, look, we got this contract signed, the vendor's locked in, meaning we get whatever extra revenue or we get a cost cut here.
Right.
Um, and that contract is in place for the next, say, 5 years. We only have a month and a half of performance. So I can't show you what the P&L looks like exactly on based on historicals, but based on this contract and based on the data that we have so far, we're pretty sure that it's in this ballpark, which can be reasonably narrowly defined. If that's what you mean by pro forma, I personally would feel comfortable with that. Unfortunately, people take advantage of the concept of pro forma,
Right.
right? Where really they use that concept to sell you on the potential of the business,
Yes, more of the potential.
not on what the business actually is. And that
Right.
that is something that I would not advise buying a business on a pro forma that's that way.
Okay, let me talk about if the company has future contracts coming soon, maybe in worth of months, that could increase 20-30% of the business, and they want to take that into account in the sale. Should we wait until those contracts hit and the money starts coming in? Because as you know, we're using debt funding, and they don't like to take chances. They're more risk adverse. So they want to base themselves on what's current and what's the past, right? So how do we go about that? Should we wait it out or?
I guess the danger of waiting it out is that they find a buyer that's willing to go for it, right? That's always a danger in markets, and the market for small businesses included is, are you? I guess the question that I would throw back at that is like, are you
Mhm.
willing to lose the deal, to wait it out and get the extra bit of certainty? And that's
Right.
something that I myself can't answer. You might have a situation where you can see that the contracts and the situation is ironclad, and there's other situations where maybe you're risking too much if you take on that particular business situation, right?
Right.
I don't know. I don't know, I think this is kind of really up to each buyer and each whatever situation that they're in. But just keep in mind that in a free market things move, right? So ask yourself, like,
Correct.
am I? And there's no right answer to this, but am I willing to lose the deal to get that extra bit of certainty?
I like that perspective, Paul. Now, touching back on getting to prove what's actual cash flow, getting the bank and credit card statements, uh, how can we go about that without making it sound so intrusive?
Yeah. So and that's always a danger. The unfortunate reality is there are business owners who aren't going to want to put that stuff out there because it's recording every little transaction, right?
Right.
Every little transaction. And what if this you know uh, what if this business owner like accidentally purchased a personal item on their business card? Like, conceivably you can get in trouble for that. I mean, probably not, because the IRS is not like they're very strapped as it is. But that might be a real concern. That might be something that spooks people, right? And so that's always a thing. Um, but this is one of those things that I would keep as an arrow in the quiver, where maybe you start with the books and you go with the bills, and if you can validate the revenue and other means, then that's great. And maybe you don't need to go to the bank and the credit card statements, but sometimes that's not the case, right? If you're negotiating with someone in good faith and they give you some stuff and you say, okay, everything is looking good so far. There's one thing that I'm kind of not sure. I'm struggling around validating, and in my effort to try to validate this, because we've exhausted the books, we've exhausted the bills, we've exhausted the other means of validation. So it would be great at this point to continue the process with you if I can get those bank and credit card statements, right? So for me, I would couch it in, this isn't something that I would ask for out of the gate. But if the talks go on and you can't validate the cash in and cash outs of the business and it's getting to that point, then that's kind of where I would bring it up, and hopefully you have an understanding buyer who wants to move, or sorry, an understanding seller who wants to move forward with you.
Correct. Now, in regards to what documents do you need to be able to make an analysis on a business? We're talking about profit and loss statement, balance sheet, cash flow statement, or the more the better?
I would say the more the better, but I think the P&L and the balance sheet plus an extra means of validation for the P&L, meaning the bills for the expenses and some other form of validation for the revenue. Between those things, I would consider that a great start.
Now, in regards to the tax documents, what do you look for in there?
So the tax documents is
because I know very quickly, banks look at the income stated in the taxes and they use that for their valuation instead of the profit and loss. What do you say?
I mean, that makes sense to me because in those cases, like this is what the person sent to the IRS, right? And the IRS is no bigger kind of like validating authority than the IRS. Like, are you willing to lie to the IRS and potentially go to prison on your books? Probably not, right? So I think that's why people are comfortable with the tax returns as a means of validation. One of the tough things would be, are you buying a business that was owned by that particular person for less than an entire fiscal year? Which it sounds like you can do that, but conceivably, like you could actually be owning it for like even 20 months and not have had an entire fiscal year to report to the IRS, right? Because what if you bought it in October? So that would get you to a year. But yeah, I mean, I think like there are some situations where it's tough to validate the business on the tax returns alone if you're buying a business that wasn't owned by that owner for long enough, or if you're buying a business that has materially changed in the past 6 months. Then the tax filings are always a good thing to have. But in those edge cases might not give you the full picture.
Right. Let me ask you about this. I got this situation where I have this guy who I was working with, but essentially he found 2 broker deals. One is doing $4.4 million in sales. They're netting about $746,000, and they're asking $1.6 million, which is really good. I calculated the DSCR on a cash flow based loan over 7 years at 5% interest rate is about 2.75, which is great for a broker deal. Thing is, it's only been in the market. It's only been in the market for a year. It's a year old. Now the other one is doing 5.5 million in sales, 891,000 net. They're asking for 2.2 million, which gives us a 2.39 times DSCR, and they've only been in the market for about 2 years, which the growth has been great in such a short period of time. But do you think that's still too early stage to get it funded with a bank, or how should he go about it?
With the first one, what was the purchase price?
Yeah, so the first one was 4.4 million in sales, 746,000 in net, and they're asking 1.6 million, which gives a DSCR of 2.75 times over 7 years at 5%. But it's 1 year old.
Got it. Yeah, that's tough. Banks, that might make a bank nervous. You know?
They want at least 3 years for, data stability. And as you know, 95% of all businesses fail in the first 5 years. Honestly, I was looking at the better option if they don't need the money, like a lot of it up front, he could seller finance a majority and finance a small portion with the bank just to give him some cash in his pocket, build it up, and then cash him out once it's more mature. What do you think about that approach?
I like that approach. I mean, yeah, basically he's getting like a kind of a almost like a cash out refinance.
Right.
And the thing is, like, he as a seller probably is not going to have many alternatives unless he runs into a buyer that just has deep pockets and can
Right.
slap
Cash.
2.3 million.
Yes. Right.
So
Right.
yeah, I like the structure. I think it's savvy. It's aware of the situation,
Yeah.
and it's aware of like the seller's alternative. So I like that a lot.
Okay, perfect. Now, let me ask you this. What's the fastest way to grow a business internally? After you acquire the business, what's the fastest way to grow it? In my mind, I'm thinking about contracts.
So this one's tough to answer because it really depends on based on the kind of business that you have. So maybe
Right. Okay, very simply, let's talk about service-based businesses.
service-based businesses.
Because, real estate base is based on the amount of rooms.
Is based on the amount of rooms. Yeah, it's a good question, but I don't know, to tell you the truth. There are so many ways to grow a business that it's that's tough to say.
Okay.
Do you have an idea that you're kicking around?
Yes. One idea I had was there was this business I was looking acquire. There were a they did cardiovascular testing. So the numbers are about the guy is doing about $2 million in sales, about 400,000 net, which is really good. He got affected by COVID, and he told me, he's not a manager, he's an inventor. With that said, he's been with the business since 2006, and he's looking to cash out. So he has 5 full-time employees, and they're able to do about 41 sales each. So each sale is about $150 each test. I calculated it's about $6,000 a day per employee. Basically, over a 12-month period, 5 days a week, 4 weeks a month, it came to about $7.3 million if they were hitting the 41 sales a day. But as you know, that's not possible. So there's 2 ways to go about it. If we double the amount of employees, we're already spending money. But if we use the same amount and we're able to do half the amount of sales, we could bring it up to $3.4 million, which is almost 1.5 more than what it currently is at 2 million, right? And that's basically growth by just better management, more sales essentially, right? And that's the difference I see between service-based businesses and real estate-based.
Gotcha. Yeah. So in this case, it's I think you have a good point that the doubling the because I guess like the basic equation of sales is like you have your volume and then you have the price per volume, right? And
Right.
to your point, like doubling the volume is tough because you're paying the cost associated with that, and a lot of times like you have to pay those employees. You pay them up front, and then they're not even that productive until whatever 6 months into the job, unless you're getting someone experienced. In that case, you're paying up, which might be okay. But one of the things that I might try is like is checking in with past customers, cross-selling past customers. You always have the lever of upping the price, but you expose yourself to competition. To me, that's like to me, what I would look at in a business like that is the tactics that the salespeople are using to make them more efficient. Like, do they have a good lead gen pipeline and lead gen funnel? Are they going after higher value customers that might pay out on 3 services as opposed to 1? Are they going for higher income individuals as opposed to lower? Are they cross-selling the people that they've already got good relationships with? Like, there are those kinds of efficiencies in a sales process that you might look into, as opposed to like a more, I guess, ham-fisted approach of just hiring the more employees and trying to scale it up that way.
Right. So 2 growth models touching into that was, and one thing I say, people are willing to buy multiple products from one trusted provider than just buying one and figuring out the rest. Example, Amazon, Walmart, so on. So if we could push more products that, work in conjunction or could benefit them, that's added sales. That's what I was thinking, right? So
yeah, exactly. And the good thing about that too is like you're getting leverage over your fixed costs whenever you can figure out how to do something like that, right? So to give the listeners another example, like when I had that laundromat, I had my coin laundry business, which is the main revenue source. And then I also had at that point, that business was paying the bills, it was paying the rent, it was paying the insurance, paying all the overhead. So when you expand into wash and fold over the counter, that's gravy because your rent's already paid for that again. So that the incremental gross profits turn into big net income. And then on top of that, you can say, oh shit, like my machines are running only, call it 10, 12 hours a day, and they're not running at nighttime, but I'm still paying rent. What if I added wash and fold and delivery business, have the trucks come in during the daytime, have the workers do it at night, so I'm utilizing my machines more, and then that extra revenue source is almost pure incremental profit because again, my rent's already paid, my overhead's already paid, then already paid.
Let me give you another example. So I learned this recently. We're looking at implementing a buy and build model. So essentially, let me give you an example with a physician office. Most of the physician offices, the smaller ones, are single independent physicians which service their community. Now, I've seen the case where there's these larger ones, 1, 2, 3, 4 million revenue, and they got multiple rooms that are empty. So one thing I learned is that you could bring in other physicians that work in conjunction with the service that is being offered there. So essentially is, more services under one roof. And the way you could structure it with the physicians is that you don't pay them, a salary, you pay him on performance, and he has to bring his own patients. What do you think about that approach?
I love that. I mean, it kind of comes back to the same concept. Obviously, very different business, but comes back to the same concept, and that concept is, how do I get more out of the assets that I already have?
Right. So let me talk about this. You said making an offer in the calculator when you updated it. You said making an offer based on a 2x DSCR can lead to overpaying, and you included other metrics in the calculator such as a return on invested capital and an NOI multiple. Can you expand on that?
I'd have to go back and look at what I did there.
Okay, no issues. Let's move forward.
I'd have to go.
One thing you told me is that as well, that we live in an age where people can get away with more things. I think you said 1 in every 100 companies get audited. Can you touch on that?
Oh, yeah. So what I was saying back when I made that comment is like, a few years ago, I think that the rate of audit from the IRS was like 1.6%. Wow. And recently, just because the IRS has become on a relative basis more resource constrained, that percentage has actually fallen to a fraction of that. So it's last I checked, fall into like 5 or 6%. Like, no, not 5 or 6%. Sorry, 0.5 or 0.6%.
Wow.
Right.
Almost nothing.
Compare that. Almost nothing. Compare that to the 1.5% that it used to be, and the audit risk is just a lot lower than it used to be, right? And so that lower risk of getting audited it means people can get away with more stuff on the aggregate, right? Some people still are not going to chance it, but the fact remains, your odds of getting audited are lower than they used to be.
Right. Now, in regards to, okay, let me touch on this. There's 2 types of acquisition purchases. You got the asset purchase, the stock purchase, and the asset purchase, right? Now, when you buy the assets, essentially it comes free and clear from any liabilities, encumbrances. If you buy the stock, that comes with liabilities. Now, as you know, there's the fact of risk to growth ratio, or essentially small businesses are small for a reason. They don't take much risk. They play safer, and larger businesses take more risk. That's why they grow exponentially. Now, taking that into consideration, if I need a license to operate in the industry or sector I'm looking to get into, could I look at acquiring a smaller business that has less liabilities, is cleaner per se, and use that license to operate other businesses, doing an asset purchase on the other companies instead of stock?
So are you asking like if by buying the business you can acquire the licenses?
So yeah, essentially, there's stock purchase and asset purchase. Stock purchase comes with the liabilities because you're buying the whole legal entity, right? So taking into account the risk to growth factor that smaller businesses play it safer than larger ones, and I need a license to operate in a sector or industry, could I buy a smaller business and use that same license to now acquire assets of other businesses, maybe larger businesses? You know what I'm saying?
I see what
And
you're saying.
de-risk,
Yeah, I see what you're
de-risk it.
saying now. Yeah, it depends on the situation because um, there are businesses where the license belongs to, and it depends what license you're talking about, because
Right.
the license might belong to the legal entity, or the license might belong to the business owner.
Okay.
Right? If you're like, for example, if you have your general California business license, that license goes to the owner, not to the entity. If you're buying a legal firm, those licenses go to the attorneys, not to the entity. But if you have for example, like a small bank, that license is to the entity, not to the owners. So
Right.
it really depends. But in theory, yeah, like you might be able to acquire the license in a small business and then use that conceive. I mean, but again, it really depends on the situation. Depends on what you're buying. Depends on the industry. Depends what you're doing.
Right. We got about 5 minutes to go. Let me ask you a couple key questions. Big one is sellers, and we talked about this a lot, but essentially brokers like to not only sell the business entity, but the assets as well, where essentially you're double paying. From what you taught me, if you're buying the business entity, it comes with the assets because anything that is used to generate the revenue or the cash flow of the business is purchased, at a multiple of the earnings of the business, right? Unless you're strictly purchasing the assets. Can you expand on that?
Yeah, exactly. So if brokers are doing that, where they're asking you to pay for the entity, and then they're also asking you to pay for the assets, that's bullshit. Let me just put it plain and simple. That's pure bullshit.
Please do.
Like, yeah. And I think the example I used with you was like if you're buying like a manufacturing.
Health. That was a home health. Remember, you said if you take the beds away, what are they gonna do? Sleep on the floor? Makes no sense.
Yeah, exactly. Yeah. So if they take away the assets from the business, then what the hell are the revenues that you're going to generate?
Yeah, you don't have a business.
Without the assets, the entity itself is worthless.
Right.
So your broker, you never accept a broker coming to you and saying, here's the purchase price for the entity, and here's also the purchase price for the assets. That is complete bullshit, pardon my language. The only caveat that I would put to this is if you're, say, buying a business that has some amount of inventory on the side, right? And even then, you might include that in the purchase price of the entity. Like in the case of like you're buying a small retailer, you might say, hey, I'm gonna take over this children's clothes store exactly as it is. Let's include the inventory in the business purchase price. Or you say, okay, I'm buying the entity clear of the inventory, right? So you have two different purchase for that. But you should never say, like, if you're buying a fucking laundromat, for example, here's the purchase price for the entity, here's the purchase price for the assets. It's a no-go because you don't have a laundromat without the assets. You don't have it without the things.
Right.
You're not generating revenue without that stuff. So, but yeah, so I rambled on that a little bit. No, but yes, that's a no-go for me.
You're great because essentially when you're buying the entity, you're not only, taking the assets, but you're taking away the liability from the guy. You're doing him a favor. And that's what people don't see. Now, lastly, asset purchase. A lot of people like to sell their assets at the price they bought it. Let me give you an example. It's a construction company. They got a 2012 Ford F-150. Let's say they paid $10,000 at that time. You search it up, they're selling about $2,000 used. You're not going to pay the $10,000, right?
You shouldn't.
You're paying essentially its resale or liquidation value. That's what banks take assets as,
Exactly. And this is exactly what I was talking about with EBITDA and depreciation before, right? Depreciation is real. If you buy a car for $10,000, 5 years later, it is not worth $10,000 anymore because it might only have a year or two left. And the price of a used car should reflect that, right? And so if you buy something that was bought new at $10,000, you're buying it 5 years later at $10,000, you overpaid because in a year or two, guess what? That thing's not going to be worth anything anymore when it breaks, and then you're going to have to buy it again, right? There's that capex. That's why I say depreciation is real, because capex doesn't go on the P&L, it goes on the cash flow statement. But over time, you are going to have to pay for that depreciation, because eventually things breaks and you're going to have to buy a new one.
Right.
So absolutely, you should not be buying used assets for the original full sticker price.
Hey, but I don't want to take too much time, but one last thing. Let's talk about the maintenance schedule for something. Let's say if they got a big equipment and they got a maintenance schedule, let's say every 6 months, 9 months, and it's about to come, let's say you're looking to acquire the business and they do it every 9 months, and maintenance schedule's coming in 2 weeks from now. Do you have to pay for that, or does the seller have to cover that because he already used it?
That's one of the kind of smaller negotiation details that you might settle between the buyer and the seller, right? It might not be that big a deal. It might be. But that's really up to the buyer and seller. That's kind of one of the finer points you might run into a negotiation. That really kind of depends on what you want to do. I guess strictly speaking, the right thing to do would be to kind of prorate the amount of maintenance, right? So if it was maintenance every 9 months and maintenance costs $900, right? You're buying this at a point where the next maintenance is in 2 months, right? So the next 2 months is going to be, you're going to get hit with that $900, right? So what you say is, okay, the past owner used these assets up for 7 months, and I'm using it up for 2 months. So let's prorate this. Seller, you pay for the 7 months, aka $700. I pay for the 2 months, aka $200, and prorating it that way. That's the fairest way to do it technically. But again, that's something that's kind of one of the finer points of the negotiation.
Paul, thank you so much for your time. Amazing value. This is a whole MBA in 45 minutes or less. I was going to ask you if later on, would you be open to coming back?
Of course.
I appreciate it. Thank you very much. Enjoy your day, Paul, and the rest of your week. Take care.
All right, Valentino, you too. Take care, and thanks for having me on.
Absolutely. Take care. Bye. Billionaire Acquisition Mastermind. Let me get Ansi on the call, man. Wait. Let me get Ansi on the call. Wait a second. Let me get him on the call. Hey, Ansi, you're on the live, boy. You couldn't join. We had some technical difficulties there. Hey, what do you thought about the live stream, the episode?
Yo.
Yeah, you there?
Yo, yeah. I got you.
Yeah, we're on the live stream. Any final words for these guys? What do you thought about the episode? We touched on a lot of points. We're definitely going to bring on Paul later on. Try to go over the calculator. That's key. Go over the calculator, explain to you guys how it works.
Right, when they start using it, they get a better idea of everything, line by line, line by line.
Right, line by line, why, how, so on. Other than that, just stay tuned for new episodes. We're gonna be pushing in more content. We're gonna have the live this morning with Marsh Sa, the dude who's done 70 acquisitions, about $5 billion worth. It was more like an intro call, so we scheduled it for about next Tuesday, next Wednesday. We got the vice president of Live Oak, who she's interested in joining in the podcast. So stay tuned. There's a lot more guys coming in